There are a lot of definitions in chapters 6 and 7. They're, I would say, by far the most technical chapters of our course together. But, on the one hand, vocabulary, it's a lot to memorize. On the other hand, it's vocabulary, and it's you learn it and you go on. One of the key distinctions is the distinction between fixed factors. I've got to get my pen. Between fixed factors and variable factors, and the connections between those factors and fixed costs and marginal costs. And the key is that when a business operates, there's fixed costs, and these costs are fixed. They're the same. They don't change whether you're producing zero units of output or 1 million units of output. Your rent for your building, the property taxes, stuff that don't change. Now, on the other hand, there's variable costs, and if I have to produce 1 more unit of output, I'm going to need more labor to put that together. Capital, by definition, is fixed in the short run in these models. If I need some variable inputs, let's say I'm making a slingshot out of aluminum. Well, I'm going to need people to work the machines that are making the form of the slingshot, and I'm going to need to use some aluminum, and depending on what else is in there, some elastic, whatever. Those are the factors that I have to use up to make 1 more unit of output. Those are variable. I use less if I'm producing less, more if I'm producing more. Anyway, when we ask the question, should I produce 1 more unit of output in the short run decision, what costs go up when I make 1 more unit of output? What's my revenue for 1 more unit of output? What's my marginal revenue, marginal cost? So it turns out that fixed costs don't increase at all when I produce 1 more unit. By definition, those costs are fixed with output. So, again, we're thinking about a firm, output. There's this competitive firm. There's a constant marginal revenue at the market price. And we map marginal cost, marginal revenue, and price. Later, we'll talk about average cost. All those have the same units, dollars per unit of output. We can map them all in the same axes. Well, the marginal costs look like that. We talked about that. Do those change when fixed costs go up? And the answer is no. The profit maximizing price falls. Well, that's somewhat silly. Marginal cost is unchanged. Yep, that's the whole. That's fixed costs are they don't affect the cost of producing 1 more unit of output. By definition, those costs are fixed. Marginal cost increases. Nope. Profit maximizing level of output increases. Nope. If the marginal cost curve doesn't change, the marginal revenue curve doesn't change, output decision stays the same. So B is our correct answer there. The buttons to go to the next page and to add a new page are right next to each other, and that's the second time I mistakenly pushed the one when I meant to push the other. All right, 14, some teams missed. I think this was far and away the hardest one, judging from the individual quiz. So let's spend some time with this one. If the firm is a price taker, then when the price of each unit of output is $30, how much profit does this firm earn at its profit maximizing level of output? Well, there's a few things. We know that the firm's going to set output where price is equal to marginal cost. We've beaten that to death by now. But the troublesome one here is our definition of profit. And the easiest definition of profit is simply total revenue minus total cost. But for this model, it's going to be useful to express profit as the difference between price and average total cost. That's profit per unit of output. And we're going to take that and multiply by the number of units of output. That's, total revenue is price times quantity. Average total cost is total cost is quantity times average total cost. Average total cost is total cost divided by quantity. So anyway, notice I can factor a quantity out of that expression and get this one. So this is going to be the definition of profit that really is useful in this framework, which is going to be our workhorse for as we go forward in the analysis of various market structures. All right, so now we're ready to answer this question. And now that we know that, it's always in hindsight easy, but now that we know that, this is going to be an easy question. But the hard part was knowing that this is the information that you needed to draw on. That's the challenge of these, is knowing which pieces of the zillion pieces of information that you have at your disposal are going to be useful for solving this question. All right, so price is $30. All right, looks like price and marginal cost are equal at a quantity of output of 80. So Q equals 80. And then we know price is equal to 30. That was given. And so our task is to figure out what average total cost is at this level of output. And here we see that it's 20. So when we plug these numbers into this formula, we get 30 minus 20 is profit per unit. $10 per unit is what we're making on average, times 80. So 30 minus 10 times 80 is 800. So answer B is the correct answer. So that, again, that was tough, and but hopefully through your work on this unit, that's going to become like falling off a log. They're really easy to do. Well, let's go to one more in this screencast. All right, two more, I guess. These I can't remember if students missed both of these or just one of these, but they must have missed both because otherwise I wouldn't have copied them both. All right, let's take 16 on. If you were to start your own business, your implicit costs, and so implicit costs are costs that are real opportunity costs but don't involve money leaving one person's bank account and going into another person's bank account. So those the costs that involve the payment of money are explicit costs. Implicit are costs but don't involve the exchange of money. So accountants take note of explicit costs, but at least for for managerial accounting, you need to know both. But if you're keeping your books for tax purposes, or a lot of profits are reported as explicit revenues minus explicit costs, and that leaves out very important implicit costs. But anyway, implicit costs. Rent that you have paid in advance. Nope, that involves somebody writing a check to somebody else, or paying cash, or transferring funds, something. Profit you earned over and above your normal profit? No, we're talking about costs, and profit is an amalgamation is a combination of revenues and costs. Interest that you pay on your business loan? Nope, money's leaving your bank account and going back to the bank, or whoever loaned you the money. Opportunity costs of the time you spend working at the business? Absolutely. That oftentimes entrepreneurs leave a job that pays them money, but instead of taking a salary, they get paid by the residual between the money they take in and the money they spend out. But you need to cost out your time using the value of your time in your next best opportunity to figure out whether it's been a smart move to leave your job and create a business or not. All right, number 17. If a firm is earning zero economic profit, then what can we assume? The firm's revenues are sufficient to pay its explicit costs, but not its implicit costs? No. In economics, we count explicit revenues, implicit revenues. That'd be the pleasure you have working a job that you love. We'd imagine some monetary value of that pleasure. The minus explicit costs and also subtracting off implicit costs. So economic profit includes all relevant costs and benefits. And if you're breaking even, that means all relevant revenues are just equal to all relevant costs. The owner will not be able to pay himself or herself a salary. That's not relevant. We would have counted a cost sufficient to pay for the owner's time. The firm's accounting profit is equal to the firm's implicit costs. Now, that's looking possible. Let's come back to that. The firm will shut down in the long run, but will continue to operate. If a firm's earning zero economic profit, that means it's doing just as well as it would be doing in its next best opportunity. So there's no incentive to leave. So the firm's accounting profit is equal to its implicit cost. That's going to be true. Remember that economic profit will always be referring to economic profit in this course, except for when we say accounting profit, is pointing out it's different. Total revenue minus total explicit costs, and we also count the total costs that are implicit. So economic profit is total revenue minus total costs, and minus, this is in parentheses, so this is a negative too, total implicit costs. So notice that the accounting profit is equal to just total revenue minus total explicit costs. So notice that by not subtracting these implicit costs, accountants would get a positive profit. If economic profit were zero and there were non-zero implicit costs, the accounting profit, this should be sub A, is going to be different than the economic profit by the amount of the implicit costs. And so firm's accounting profit is equal to the firm's implicit costs. This was a really hard one. Some of them are harder than others. I would say as a group, you guys did great on this readiness assurance process quiz. The average was up close to 70%, which is really high for the IRAP, and then the TRAPs. The team quizzes were really, really high above that. Good job.